Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the volatility index on the CBOE, and that's ticker symbol VIX. I normally don't start off with this one. I usually save it for last, but I thought it was important to analyze this first because as I talk about this each week, I mentioned that it's a leading indicator for the S&P. And so you can see from the chart right here, I left my lines on the candle chart from last week so you can see just how accurate the candles were. And this red diagonal line is what I drew last week. Now remember, last Friday, these candles were not on the chart yet, so all I did was draw the line. And I said that we would most likely rally up to this resistance area right here, and that's exactly what happened. Now there's another part to this story. If you look down at the bottom of the chart, you'll see this is the stochastics oscillator, and as I back out of this, you'll see that there's two parallel lines here. The bottom line registers in at 20 on that scale from 0 to 100. The upper line running parallel here is at 80 on that scale from 1 to 100. And so anything over 80 is considered an overbought condition. Now, there were only 4 other times this year that we even touched that line. Here you can see that back in December of 2017, we breached it, and then we started coming back. Now, when this is registering an overbought condition, that doesn't mean it's a sell signal. It just is basically defining that market as overbought. Now, I do believe the VIX will pull back next week. So what I'm going to do is really extend this out in a downward direction now. I think the VIX is going to pull back to this moving average, and then we'll have to see whether or not it breaks out of this resistance high. Remember, if it breaks out of these resistance highs, that's bearish for the market. Remember, I said it's inversely related to S&P. So with that said, let me go to the S&P. It's ticker symbol SPY. It's ETF for the S&P 500. And as I zoom in here, you can see again, I left my lines in place from last week. And you can see we hit another home run. This was the diagonal line. I said we would pull back to fill this gap and most likely pull back to the 20-period moving average. And again, that's exactly what has happened. 1, 2, 3, 4, 5. It was almost as if the market was following my trend line that I drew last week. And of course, I'm not the one that's leading the market, but I am definitely reading the market and interpreting these charts for you so you can get a better handle on what the signals are telling us. Now, you can see the price is right at that 20-period moving average, and the volume is increasing now on that green candle. So there's an 80% chance that after this gap is filled, there's an 80% chance that we'll rally. And so I believe that next week, the S&P will start to move up just like that. And notice how I'm drawing this line parallel to the line that I drew 2 weeks ago. Each and every one of these lines that I've left in place here are previous forecasts. So again, you can see how accurate the charts are when you know how to read them correctly and interpret the signals. So again, S&P, I'm a little bullish for next week, mainly because the VIX is bearish. The VIX leads the S&P and they're inversely related, so I'm looking for higher prices in the S&P. Now, if we look at the Qs, which is the NASDAQ market, it's power shares basically representing the tech sector, and if I zoom in here, you'll see again, this is the line that I drew last week. There was nothing here last week. Last Friday was right here. I mentioned that this was a doji, which is a sign of indecision. I pointed that out and highlighted some previous dojis and showing you what happens at these pivot points. A doji, to review, is a sign of indecision. We usually find those at the points where we have a shift between the supply and demand. In this case, it shifted to the downside. We had more supply than demand. But now look, you could see that this is a green candle And the stochastics down here is very, very close to being oversold. Remember, below 20 is oversold. So I believe that the Qs are going to rally just like the S&P. And I'm going to draw this out right here. I'll erase this line just so that doesn't get in the way. And you'll see that this diagonal line is what my forecast is for next week. And I do believe that there is some strength moving in the market. Unemployment numbers look strong. Economic reports are very positive. So I think that the buyers will start to creep back in off the sidelines. They'll start putting some of their money in. Some of the Tesla investors are looking for an alternative investment. That stock took a pounding this week. But you have all the signs of bulls moving in. The buyers are showing more signs of life than the sellers. And so I think the Qs are going to rally next week. Now let's go and move to a more broad-based index, which is the Russell 2000. I said last week that we would pull back, and the end of that line was my target. We more or less passed through that on day one of, on Monday, we came right to that. Actually, that was Tuesday. We came right to that, and we continue lower. Now, this candle right here is very, very close to a doji. Remember what I just mentioned, that being a sign of indecision. We're very close to being oversold in the Russell 2000, so I think next week there will be a pivot point, and I think the Russell 2000 will start to rally just like that. I'm drawing this angle almost at a 45-degree angle, probably closer to a 50-degree angle, and that seems to be the pattern that we're seeing in the market. When the market rallies, it tends to rally in this 50-degree angle. So that's for the Russell 2000. Now, finally, let's go to the diamonds. We hit a home run on all of the other markets, including the VIX as the indicator. I said that the diamonds will most likely pull back. We did that, but notice something right here. We have 5 consecutive green candles in a row. We tried to go down on Tuesday, almost to my target here, but notice what happened. On Tuesday, we filled this gap right here. You see that? So let me erase this now that we talked about the analysis. And I'm actually going to erase I'm going to erase all of these because I want to show you what's happening with this particular gap. Now that this gap is filled, 80% of the time after a gap fills, the market reverses from the gap fill point. And that's exactly what we saw here. On Tuesday, the market came down, the low filled the gap, and then it bounced. This is now established as a support level. So I think that while the Dow is not in an oversold condition, I think that the buyers will continue to come back in. Remember, this is the Dow 30. The Russell 2000 is 2,000 stocks, so that carries some more weight. But the Dow 30 here, I think, are looking more bullish than bearish, mainly because it's so close to this support level, and I think that would attract more buyers into the market. Now, if you'd like to learn more about what we do at The Market Guys, just go to The Market Guys website. That's themarketguys.com. And I would suggest you click on the video tab right there at the top of the page, and that will bring you to a video library that's just loaded with lessons and very short videos that we call market shots. If you go down, you'll see that there's a video that talks about the role reversal. That's something that I talked about. And also, you might want to review trading the gap. It'll talk more about the 80% rule that I talk about with regard to gaps filling and reversing from the gap fill point. So hopefully that will help you. Have a great weekend, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.